September 1929. Wall Street hits historic records. The Dow Jones reaches 381 points, a number that seemed impossible just 5 years earlier. Newspapers from coast to coast announce in triumphant headlines, "Prosperity is here to stay." Ordinary families invest their life savings in the stock market. Bankers celebrate at luxury dinners. Economists from Yale and Harvard publicly declare that the United States has entered a new economic era. 3 weeks later, on October 24th, the world collapses. Not gradually, but in a financial avalanche that swept away fortunes in a matter of hours. What did nobody notice? The collapse didn't begin on the day of the crash. It began months earlier, in the moments of greatest euphoria, on the days when everything seemed perfectly safe. Today, in November 2025, the same behavioral patterns are repeating. The same indicators are flashing red. The same collective psychology is taking hold of the masses. And history has a frightening accuracy when people stop paying attention to the details that truly matter. This is not a video about fear. It's about recognizing patterns that have repeated for centuries. It's about understanding what happens before major falls, not after. Because when most people realize it, it's already too late. Let's go back in time. January 1929. The United States was living what many called the Roaring Twenties. World War I had ended. Industrialization was transforming the country. Cars, radios, electricity, everything was expanding at a speed never seen before. Between January and September 1929, the Dow Jones rose an impressive 27%. To put this in context, that's faster than the post-COVID recovery of 2020 to 2021. Unemployment was at historic lows, below 4%. Credit flowed freely through the streets of every American city. Banks competed to lend money. Ordinary people who had never invested before opened brokerage accounts. There were real stories of taxi drivers, cleaning ladies, and factory workers who became rich overnight buying stocks. The most respected economists of the era, those with PhDs from the most prestigious universities, affirmed with absolute conviction that the United States had entered a permanently high plateau of prosperity. This is not a phrase invented for drama. It's a literal quote from Irving Fisher, economist at Yale, considered one of the most brilliant thinkers of his generation. He said this publicly in October 1929, just days before the crash. So what went wrong? How could such intelligent people, with access to all available data at the time, have been so catastrophically wrong? The problem wasn't in what people saw. It was in what they actively chose to ignore. Because the signs were there, screaming, but invisible to those who didn't want to look. Bank debt margins had tripled in just 3 years. In simple terms, banks were lending 3 times more money than they had in reserve. 40% of all stocks in the market were bought with borrowed money, using a mechanism called margin buying, buying stocks by paying only 10% of the value and financing the other 90%. Imagine buying a house paying only the down payment and hoping the price rises to pay the rest. Now imagine that 40% of the entire market was functioning like this. And there's more. Companies reported record profits on their balance sheets, while actual industrial production had already begun to fall since July 1929. The numbers didn't make sense, but nobody questioned it. Why question when everyone is making money? Now, let's move to 2025. 3 indicators replicate this pattern with a precision that is mathematically impossible to ignore. Indicator 1. United States corporate debt, non-financial corporate debt in the US reached $10.5 trillion in 2024, according to Federal Reserve System data. To put this in context, this represents approximately 40% of American GDP, the highest level ever recorded since, you guessed it, 1929. This is not opinion. It's public data available on Fred Economic Data, the official database of the Federal Reserve of St. Louis. Companies are taking on debt not to invest in real growth, but to buy back their own shares, artificially inflate their prices, and maintain the illusion of prosperity. It's a cycle that only works while interest rates remain low and investors remain confident. Indicator 2, the Buffett indicator. Warren Buffett popularized a simple indicator, dividing the total market value of all stocks by the real economy, GDP. When this number exceeds 100%, it means the market is overvalued relative to actual wealth production. In 2024, this index reached 185%. For comparison, it was at 145% before the crash of 2000, the dot-com bubble, and at 105% before 2008, the subprime crisis. Historically, any value above 120% precedes severe corrections. What does this mean in practice? That the market is paying almost double what the real economy justifies. It's like paying $1 million for a house worth $500,000 simply because everyone else is doing it. Indicator 3. Margin debt in brokerages. After the crash of 2008, the use of margin, buying stocks with borrowed money, dropped drastically. People learned their lesson. Or at least that's what we thought. Between 2020 and 2024, margin debt grew exponentially again, reaching $773 billion by mid-2024, almost the same peak as 2007, before the crisis. The pattern is identical to the period 1925 to 1929. Euphoria, easy credit, unsustainable leverage. This is not conspiracy theory, it's not clickbait. These are verifiable data from the Federal Reserve, Bank for International Settlements, and Fred economic data. Anyone can access and confirm these numbers. But here's the crucial point. In 1929, people also had access to data. Banks published reports. Economists analyzed numbers. The difference isn't access to information. It's the willingness to believe in something that contradicts the comfortable narrative that, this time, is different. There is a documented phenomenon in behavioral economics that explains why crises always catch most people by surprise, even when the signs are obvious in retrospect. It's called the Minsky moment, named after economist Hyman Minsky, who dedicated his life to understanding why financial systems collapse. Minsky's central thesis is disturbing in its simplicity. Stability breeds instability. The longer a system remains stable, the more people take risks, until the risk itself becomes unsustainable and the system collapses. Let me explain how this works in practice in 3 phases. Phase 1. Hedge, conservative safety. Right after a crisis, people become cautious. They take loans only when they're absolutely certain they can repay them with their regular income. Banks are conservative in lending. Companies invest only in projects with guaranteed returns. There's memory of recent pain. Nobody wants to repeat the mistake. This phase happened between 2009 and 2012. After the crisis of 2008, people were afraid. Savings rates skyrocketed. Credit was restricted. It was difficult to get financing. The system was healing. Phase 2. Speculative, growing confidence. A few years pass. The economy recovers. People begin to forget the last crisis. The pain diminishes. Confidence increases. In this phase, people and companies begin to take credit, counting not just on their current income, but on the expectation that their assets will appreciate in the future. I'll buy this property because, even if it's slightly above my budget, the price will rise and I can sell for profit if I need to. This phase clearly happened between 2013 and 2019. Confidence returned. The real estate market recovered. The stock market reached historic highs. The memory of 2008 began to fade. Phase 3. Ponzi, dependence on new credit. This is the most dangerous phase, and it's when the system is already doomed, even though nobody realizes it. In this phase, companies and individuals depend on new loans to pay old debts. There isn't enough real cash flow. The only thing keeping the system running is the continued willingness of creditors to provide more money. It's literally a Ponzi scheme on a macroeconomic scale. The name Ponzi comes from Charles Ponzi, who in the 1920s created a fraudulent scheme where he paid old investors with money from new investors without generating real profit. Eventually, when new investors stopped coming in, everything collapsed. In 1929, the United States was definitely in phase 3. Companies took on debt to pay dividends. People took loans to buy more stocks. Banks lent money they didn't have. The entire system depended on a continuous flow of new credit. When that flow stopped, not for a dramatic reason, but simply because some banks started getting nervous, everything collapsed in cascade. Now, the trillion-dollar question: What phase are we in today? 3 key indicators suggest we've entered phase 3. Indicator A, savings rate of American families. In 2024, the personal savings rate in the US fell to 3.4%, the lowest level since 2005, immediately before the crisis of 2008. To contextualize, historically, the healthy average is between 7 and 10%. This means American families are spending almost everything they earn, and in many cases, more than they earn. Why does this matter? Because when there's no savings, there's no safety margin. Any shock, job loss, medical emergency, interest rate increase immediately turns into default. Indicator B, credit card delinquency. The delinquency rate on credit cards reached 3.1% in the second quarter of 2024 and is on an upward trajectory. This is the highest level since 2012. More worrying, delinquency is increasing even with relatively low unemployment. What does this indicate? That people aren't defaulting due to lack of employment, but because their debts have already exceeded their payment capacity, even while employed. This is a classic characteristic of the Ponzi phase. You need more credit just to maintain what you already have. Indicator C, zombie companies. The Bank for International Settlements defines a zombie company as one that doesn't generate enough operating revenue even to pay the interest on its debts. It only survives by taking new debts or refinancing old ones. In 2024, approximately 20% of companies listed in developed markets fit this category, the highest percentage since they began measuring in 1980. 20%. This means 1 in every 5 publicly traded companies only exists because creditors remain willing to lend money, not because they generate real value. What happens when interest rates rise or when creditors get nervous? These companies collapse. And when 20% of companies collapse simultaneously, it's not a normal recession. It's a systemic catastrophe. The psychological pattern is identical to 1929. Normalization of extreme risk. People stop seeing danger because it has become the new normal. But there's a critical difference between 1929 and now. And this difference can be both our salvation and the accelerator of the next fall. If you're thinking, but wait, today's situation isn't exactly like 1929, because now we have protections. You're absolutely right. And this is important to recognize to maintain the intellectual credibility of this analysis. In 1929, there was no one FDIC, Federal Deposit Insurance Corporation. Created in 1933, after the collapse, the FDIC guarantees bank deposits up to $250,000. In 1929, when a bank failed, depositors lost everything, literally. Their life savings evaporated. This created mass bank runs, desperate people running to withdraw their money before the bank closed, which in turn caused the bank's collapse, creating a vicious cycle. Today, even if a bank fails, your deposits are insured. This, in theory, should prevent bank runs, in theory. 2. Federal Reserve acting as lender of last resort. In 1929, the Federal Reserve existed, but didn't act aggressively to save banks. Today, we learned the lesson. In 2008, in 2020, the Fed injected trillions of dollars to avoid total collapse. They have tools and willingness to intervene. 3. Regulation on bank leverage. After 2008, regulations like Dodd-Frank and Basel III were implemented, requiring banks to maintain more capital in reserve. In 1929, banks operated with leverage of 30-to-1 or even more, lending $30 for every dollar they had. Today, this is technically illegal. 4. Social protection programs, unemployment insurance, Medicare, Medicaid, food stamps, none of this existed in 1929. When someone lost their job, there was no safety net. Today, although imperfect, these programs cushion the social impact of economic crises. So, taking all this into consideration, why should we worry? Haven't we built a collapse-proof system? The short answer, no. We built protections against the specific mechanisms that caused the collapse of 1929. But we simultaneously created new vulnerabilities that didn't exist at that time, and these new vulnerabilities may be even more dangerous. Vulnerability. 1. Instant global interconnection. In 1929, when a bank failed in New York, it took days or weeks for panic to spread geographically. Information traveled by telegraph and newspaper. People had time to process, to think. Today, a bank can fail in Switzerland, and within 6 hours, there's a digital bank run in Tokyo, London, and São Paulo. We're not talking about people physically running to bank branches. We're talking about millions of simultaneous clicks trying to transfer money before bank managers even wake up in the morning. In March 2023, we saw a preview of this with Silicon Valley Bank. The bank didn't fail due to real insolvency in the traditional sense. It failed because $42 billion were withdrawn in less than 24 hours via digital transfer. That's 20% of all the bank's deposits evaporating before containment measures could be implemented. Historic. It had never happened before. Imagine this happening not with a regional bank, but with one of the big systemic banks. JP Morgan, Bank of America, HSBC. The speed of contagion today is exponentially greater than in any previous historical period. Vulnerability. 2. Derivatives and systemic complexity. In 1929, the financial system was relatively simple. You deposited money in the bank. The bank lent that money. Loans were paid or not. Simple. Today, the global derivatives market is estimated at over $600 trillion in notional value. To contextualize, that's approximately 8 times global GDP. Derivatives are financial instruments whose value derives from another asset. Options, futures, swaps, CDOs, CDSs. Most people, including many who work in banks, don't fully understand how they work. The problem isn't that derivatives are inherently bad. The problem is that they create invisible chains of interdependence. Bank A owes Bank B, which owes Fund C, which owes Bank D, which owes Bank A. When one link breaks, the cascade is unpredictable and uncontrollable. In 2008, we discovered this the hard way when Lehman Brothers failed and almost took the entire system down with it. And even after all the regulations implemented since then, the derivatives market today is larger than it was in 2008. Vulnerability. 3. Technology dependence. The global financial system now operates 24/7 through interconnected digital networks. High-frequency algorithmic trading represents over 70% of transaction volume on Wall Street. It's not humans making decisions. It's algorithms responding to other algorithms in microseconds. What happens when algorithms enter a negative feedback loop? We've already seen flash crashes. In moments when the market plunges 10% in minutes, with no fundamental reason, just because algorithms started selling in cascade. Now add the human factor, social panic amplified by social networks, a viral tweet, a YouTube live stream, a TikTok video. False or partial information spreading faster than fact-checking can keep up. And millions of people making financial decisions based on fear, not analysis. So yes, we have protections that didn't exist in 1929. But we also have vulnerabilities our grandparents couldn't even imagine. And here's the most disturbing sign that very few people are paying attention. To coordinated central bank meetings. The Bank for International Settlements, based in Switzerland, is often called the Central Bank of Central Banks. It's where leaders of the Federal Reserve, European Central Bank, Bank of Japan, and others meet to coordinate policies and discuss systemic risks. In 2024, the BIS held financial stability meetings with a frequency 40% higher than the historical average. These meetings aren't widely publicized, they don't appear in headlines, but the records are in public reports available on the BIS website. Why does this matter? Because central banks only coordinate this way when they're genuinely concerned about systemic risk, when they believe a problem in one region could contaminate the global system. They don't do this for minor problems. They do it when they sense something big might be forming. I'm not saying they know a crisis will happen. Nobody knows. But the fact that they are preparing this way indicates that the warning signs we discussed aren't paranoia. They're real risks being taken seriously at the highest levels of global financial governance. If you've made it this far, you deserve more than analysis. You deserve clarity on what to actually do. Because understanding the problem without knowing how to protect yourself is just organized anxiety. I'll be direct, there's no magic formula. Nobody, and I repeat, nobody, can predict the exact timing of crises. Economists with PhDs from Harvard got it wrong in 1929. Experienced analysts got it wrong in 2000. Billionaire fund managers got it wrong in 2008. So the strategy isn't about predicting. It's about not being destroyed if it happens, and prospering if it doesn't. Move 1. True defensive diversification. When most people think of diversification, they think of having stocks from different companies. Technology, healthcare, energy. That's not real diversification. It's the illusion of diversification, because when the entire system collapses, all stocks fall together, regardless of sector. Real diversification means being exposed to asset classes that don't move in the same direction. Low-risk assets, 25 to 30% of portfolio government bonds from stable countries. Not because they'll make you rich, but because they're what historically maintains value when everything else is in freefall. In 2008, while stocks fell 50%, US Treasury bonds rose. Exposure to different currencies. If all your wealth is in a single currency, you're making a giant bet on a single government. Having exposure to dollars, euros, and even a small percentage in gold or other stores of value protects against localized monetary collapse. Inflation protection, real estate, if purchased responsibly, not with excessive leverage. Commodities, real assets, things that maintain intrinsic value regardless of what happens to paper money. The key is, this diversification needs to be implemented before the crisis. When everyone is trying to protect themselves at the same time, protection prices skyrocket and you lose the window. Move 2. Strategic liquidity, the silent salvation. This is the least sexy but statistically the most important. Having 6 to 12 months of expenses in liquid reserve, money you can access immediately without selling anything. Why is this crucial? Because crises don't destroy just through loss of assets, they destroy through loss of time. During recessions, the average time for professional relocation triples. If you would normally take 2 months to find a new job, in a crisis, it can take 6 months. People who survived 2008 weren't necessarily the smartest or the richest. They were those who had liquidity to wait, to not be forced to sell assets at the worst possible moment. To be able to say no to a bad job offer and wait for a better one. Liquidity is time. And time is the difference between panic and strategy. Oh, but if I leave money sitting, I'll lose profitability. Yes, and that's exactly the point. Car insurance also costs money. You don't complain that you're losing profitability by having insurance. Emergency reserve is financial life insurance. You move 3. Continuous financial education. The biggest mistake of 1929 wasn't not predicting the crash. It was not understanding the basic fundamentals of how economic cycles work. People who understood these fundamentals, even without predicting the exact timing, made better decisions before, during, and after the crisis. Financial education doesn't mean becoming an expert in the stock market. It means understanding how debt works and when it's a tool versus when it's a trap. What it means for a company to be solvent versus profitable. How interest rates affect your real life. The difference between price and value. How to recognize speculative bubbles versus sustainable growth. This knowledge won't make you rich quickly, but it will prevent you from being destroyed quickly. And here's the truth nobody wants to admit. The vast majority of people who lost everything in 1929 weren't the poorest. They were middle-class people who had saved for years, thought they finally knew how to play the game, and threw everything into something they didn't fully understand. Intellectual humility, recognizing what you don't know, is a more valuable financial protection than any investment tip. Let's establish something important. This video is not a warning for you to sell everything, withdraw your money from the bank, and live in fear under your bed. That would be as irrational as completely ignoring the signs. The uncomfortable truth we need to accept: nobody knows if 2025, 2026, or 2027 will be the next 1929. Nobody. Not the world's most brilliant economists, not fund managers with access to data you and I don't have, not central banks with all their analytical tools. Economist John Kenneth Galbraith, who wrote the definitive book on the crash of 1929, said something profound. There are 2 classes of economic forecasters: those who don't know and those who don't know they don't know. So if we can't predict, what's the point of this entire video? The point is the distinction between probability and certainty. We can't be certain a crisis is coming, but we can observe that behavioral patterns, debt indicators, mass psychology, and systemic structures are echoing the past with a precision that would be irresponsible to ignore. It's the difference between seeing dark clouds and knowing it will rain. Dark clouds don't guarantee rain, but it would be foolish to leave home without at least considering taking an umbrella. Intelligent preparation isn't pessimistic, it's probabilistic. And here's what history repeatedly teaches us. The difference between who was financially destroyed in past crises and who not only survived but prospered wasn't luck. It wasn't IQ. It wasn't privilege. It was silent preparation while others celebrated. The people who survived the crash of 1929 and even took advantage of opportunities afterward weren't those who predicted the exact date. They were those who had liquidity when others didn't, understood fundamental value and could buy quality assets when they were on forced sale, weren't leveraged and therefore weren't forced to sell at the worst moment, had valuable skills that remained in demand even in recession. Note that none of these 4 points require predicting the future. All of them require only discipline in the present. In Warren Buffett has a famous phrase, "Be fearful when others are greedy, and greedy when others are fearful." It sounds simple, but it's psychologically one of the hardest things to do, because it requires acting against the herd instinct. In 1929, it was being conservative when everyone was euphoric. In 2008, it was buying when everyone was selling in panic. Today, in 2025, it's being prepared while others assume everything will be fine forever. I'm not saying you should be terrified. I'm saying you should be attentive. You should know the signs. You should have made the defensive moves that make you resilient to shocks. Because here's the beauty of intelligent preparation. If the crisis doesn't come, you haven't lost anything significant. Having an emergency reserve, sensible diversification, and financial education are beneficial regardless of whether or not there's a Great Depression 2.0. But if the crisis comes, the difference between prepared and unprepared can literally be the difference between maintaining your quality of life and losing decades of financial progress. There is a meta pattern in all major financial crises in history that needs to be said explicitly. Crises always catch most people by surprise. Always. Not because the signs weren't there, but because most people, even intelligent people, choose not to see until it's too late. Why? Basic human psychology, normalcy bias. Things have always been this way, so they'll continue being this way. Our brain assumes the present is permanent. It's an evolutionary survival mechanism. If you're in a constant state of alert for hypothetical dangers, you become paralyzed. Social cost of being the pessimist. In 2006 to 2007, there were economists and analysts warning about the housing bubble. You know what happened to them? They were ridiculed, called alarmists, chronic pessimists, people who didn't understand the new market reality. Michael Burry, the investor who predicted and profited from the crisis of 2008, and whose story was told in the film The Big Short, was literally threatened with lawsuits by his own investors because he was betting against the market while everyone was still making money. There's a real social cost in being prepared for something most people don't believe will happen. And that cost makes many intelligent people choose silence or conformity. Perverse short-term incentive. For financial professionals, there's a perverse incentive. If you're right about a crisis but too early, you lose clients, lose bonuses, lose position. If you're wrong, but everyone is wrong together, you keep your job. As Keynes said, markets can remain irrational longer than you can remain solvent. So we have a situation where ordinary people don't want to believe bad news. Professionals have incentive not to sound the alarm too early. Those who warn are socially penalized. The result? The alarm only sounds when it's already obvious to everyone. And when it's obvious to everyone, it's already too late to protect yourself. This isn't moral failure. It's structural failure in how human systems process long-tail risks. And that's exactly why you, individually, need to take responsibility for your own preparation. Because the system won't warn you with enough time. So, after all this, what's the takeaway? It's not, a crisis will happen tomorrow. It's not, sell everything and panic. It's not even, ignore everything and trust the government will solve it. The takeaway is, We are living the most valuable moment of any economic cycle, the period before a potential crisis, when there's still time to prepare. If a crisis doesn't happen in the coming years, great. You'll have a solid emergency reserve, sensible diversification, superior financial knowledge, and zero regrets. If a crisis happens, you'll be one of the rare people who weren't caught by surprise, who had liquidity when others had panic, who understood what was happening when others were confused, who could take advantage of opportunities when quality assets were on forced sale. History isn't just repeating, it's giving us the same chance it gave previous generations, the chance to learn from the past before repeating its mistakes. Most will ignore this warning, because it's uncomfortable, because it requires change, because it's easier to assume this time is different. But you, who watched until here, have a choice. You can be like Irving Fisher, the brilliant economist from Yale, who in October 1929 said stocks had reached a permanently high plateau and lost the equivalent of $140 million in today's money. Or you can be like those who silently prepared, who didn't predict the future but understood the patterns, who didn't have a crystal ball but had discipline. History is not destiny, but patterns are probability, and now you know the patterns. If you want to continue understanding what the numbers really say, while headlines sell easy optimism and algorithms show you only what you want to see, subscribe to this channel. Next video. The 3 financial protections nobody teaches you, and that saved fortunes in 2008. Because here we don't sell certainties, we sell patterns, data, and preparation. History doesn't repeat exactly, but it rhymes with a precision that would be foolish to ignore. And those who listen to the rhymes are rarely caught by surprise.